Most people believe that becoming wealthy is simply a matter of earning more money. Work harder, get promoted, pick up a side hustle, and eventually, the numbers will add up. That is what we are told. That is what feels logical. But the data tells a very different story. And if you have ever looked at your bank account at the end of the month and wondered why nothing seems to stick, that story matters to you right now. Here is what the math actually shows. The average American household earns roughly $74,000 per year, and yet the median savings account balance in this country sits at just $621. Not $6,000, not $60,000, $621. You can earn a six-figure income for 20 consecutive years and still retire with almost nothing. And that is not a personal failure. That is a system failure. Specifically, a failure to understand the three mathematical thresholds that determine everything about your financial future. Today, we are going to walk through those three milestones, not as motivational targets, but as mechanical inflection points where the math itself fundamentally shifts in your favor. And once you understand these thresholds, you will never look at your money the same way again. Before we get into the numbers, let us establish why this particular framework matters more than any budgeting app, savings challenge, or investment tip you have ever come across. The reason most personal finance advice fails people is not because the advice is wrong. It is because it treats all stages of wealth building the same way, as though a person with $200 in savings needs the same strategy as someone with $50,000 invested. The reality of building wealth is deeply nonlinear. There are long, frustrating stretches where nothing seems to be working. And then there are specific crossing points, thresholds, where the entire game changes beneath your feet. The first $10,000, the first $100,000, and the point where your investment income surpasses your earned income, these are not arbitrary numbers. They represent three completely different psychological, mechanical, and lifestyle realities. And the people who understand this distinction almost always outperform those who do not. Not because of intelligence, but because of clarity. So here are the three milestones. We are going to spend real time on each one, the psychology behind them, the math inside them, and the behavioral traps that destroy people at every single stage. Let us start at the beginning. Milestone 1. The first $10,000. Most people think saving money is a linear process. You set aside a little each month, the number grows, and one day you have enough. But the experience of going from $0 to $10,000 does not feel linear at all. It feels almost impossible for the first few months, then suddenly, progressively, manageable. And there is a specific reason for that. The first $10,000 is primarily a psychological milestone. It represents the moment where your relationship with money begins to shift from reactive to proactive. Before this point, every financial decision is made from a posture of scarcity. You are managing shortfalls, responding to emergencies, and making choices driven by what you cannot afford. Every unexpected expense feels like a catastrophe because structurally, it is. A $400 car repair, a medical copay, a delayed paycheck. These events do not just inconvenience you, they can cascade into credit card debt, overdraft fees, and months of recovery. The math here is brutal and simple. If you do not have an emergency fund and you put a $400 expense on a credit card carrying 24% annual interest, that single event costs you more than $400 before it is resolved. You have entered what behavioral economists call the poverty trap, where the absence of a financial buffer forces you into financial products that accelerate wealth destruction rather than creation. The mechanics. But once you cross that $10,000 threshold, something mechanical changes. You now have a genuine emergency fund, roughly 3 months of basic expenses for someone in the median income range. And that fund does something that sounds simple but is actually profound. It removes the behavioral urgency that drives most destructive financial decisions. You stop choosing payday loans. You stop carrying revolving credit card balances out of necessity. You stop negotiating from desperation. Research in behavioral economics shows consistently that access to liquid savings, even modest savings, measurably improves long-term financial decision-making. Not because people suddenly become smarter, but because the stress of financial scarcity literally reduces cognitive bandwidth. Studies from Princeton and Harvard have demonstrated that financial insecurity functions similarly to a cognitive tax, consuming mental resources that would otherwise go toward planning, problem-solving, and delayed gratification. The first $10,000 does not just protect you financially, it gives you your brain back. The trap at this stage. But here's the problem most people encounter at this milestone. The moment they reach $10,000, they experience what I call false arrival, the psychological sensation of having made it. Suddenly, the gym membership upgrade seems reasonable. The vacation feels earned. The new car payment feels manageable. And because the number is concrete and visible, it becomes very easy to spend back through it within 6 to 12 months, resetting the clock entirely. This is not a willpower problem. It is a systems problem. The brain interprets the arrival at a goal as permission to relax. And without a clear next target already established, that is exactly what most people do. The solution is to treat the first $10,000 not as a destination, but as a floor. The minimum operating balance below which you will not allow yourself to fall. Once it is set as a floor, the psychology shifts from accumulation to protection, which is far more durable over time. How to get there? Faster. If you want to reach this milestone efficiently, focus on 3 things simultaneously. First, automate a fixed transfer to a high-yield savings account on every payday, not what is left over, but a scheduled, non-negotiable amount, even if it is $50. Second, audit every recurring subscription and monthly fee with the specific goal of freeing up cash for this one account. Third, treat any windfall, tax refund, bonus, a cash gift, as emergency fund fuel before it touches your spending accounts. These 3 mechanics alone, applied consistently over 12 to 18 months, will get most people to $10,000 regardless of income level. Milestone 2. The first $100,000. Charlie Munger, the late billionaire partner of Warren Buffett, said something remarkable in an interview that has since become one of the most quoted pieces of financial wisdom of the last century. He said the first $100,000 is incredibly difficult, but once you have it, you should do whatever it takes to get there, because after that, the math starts working for you instead of against you. And when you understand the mechanics behind that statement, it stops sounding like motivational advice and starts sounding like pure mathematics. Here is the math. $100,000 invested in a diversified index fund, historically generating an average annual return of around 8 to 10%, produces $8,000 to $10,000 of growth per year without a single additional contribution. That is equivalent to a part-time job, generated entirely by capital you have already accumulated. At $10,000 in savings, the same return rate generates $1,000 per year. Meaningful, but not yet transformational. The difference between $10,000 invested and $100,000 invested is not just a factor of 10 in the balance. It is a factor of 10 in the leverage your money has over your financial future. The mathematics of time, this is where the math becomes genuinely extraordinary. $100,000 left untouched in an investment generating 9% annual returns becomes approximately $672,000 in 20 years with 0 additional contributions. Not because of financial wizardry, because of time and compounding. The same $100,000 contributed in monthly installments over those 20 years would produce a far smaller final balance, because early contributions have more time to compound than late ones, which means the single most important variable in the equation is not how much you earn, how frugal you are, or how sophisticated your investment strategy is. It is when you start and how consistently you allow the math to run. The psychological shift at $100,000 beyond the mechanics to reaching $100,000 in net investable assets produces a psychological shift that is qualitatively different from any previous milestone. At $10,000, you stop making panic decisions. At $100,000, you start making genuinely long-term ones. The time horizon of your financial thinking expands. You begin thinking in decades rather than months. You become less susceptible to market volatility because a 10% drawdown, while representing $10,000 in paper losses, no longer threatens your immediate stability the way a $1,000 loss might have at an earlier stage. This is documented in investment behavioral research. Investors with six-figure portfolios are statistically far more likely to hold through market corrections and benefit from the recovery than those with smaller balances, because the emotional and financial cost of waiting is proportionally lower relative to their buffer. The $100,000 milestone does not just change your math, it changes your relationship with financial time itself. The trap at this stage. Now here is where the mid-video reality check becomes critical, because this is the single most dangerous point on the entire wealth-building journey. The moment people cross into six figures of net worth, lifestyle inflation accelerates. The car lease upgrade, the larger apartment, the business class upgrade that seems reasonable now that you are doing well. Each individual decision seems justified, even logical, given the new income or asset level. But together, they represent what researchers call the hedonic treadmill, a continuous reset of the spending baseline that permanently offsets the compounding potential of your capital. The math on lifestyle inflation is genuinely sobering. An extra $400 per month redirected toward consumption rather than investment, over 20 years at a 9% return, represents over $300,000 of lost compounding. That is not $400 per month wasted. That is a retirement outcome fundamentally altered. And it happens gradually, invisibly, through dozens of individually defensible decisions that collectively add up to a structural shift in your financial trajectory. How to accelerate this milestone? 3 strategic principles accelerate the journey from $10,000 to $100,000 more reliably than any others. First, maximize the gap between your income and your spending. Not through deprivation, but through deliberate design. Automate your investments before lifestyle spending has access to new income. Second, understand the specific compound math of your own situation. Run the numbers on what you currently invest and what that becomes in 15 years, because seeing your actual trajectory tends to be far more motivating than general principles. Third, do not diversify your income streams prematurely. There is a common trap at this stage of focusing energy on passive income ideas before the foundational portfolio is in place. Concentrate on building the $100,000 base first. The options that base creates are far more valuable than any side hustle launched before it exists. Milestone 3. The income crossover. The third milestone is different in nature from the first two. It does not have a fixed dollar amount. It is a ratio, specifically the point at which your investment income, passive income, or capital returns begin to equal or exceed your earned income. This is what financial theorists call the crossover point, and it represents the fundamental structural shift from being a worker in an economy to being a capital owner in an economy. These are not semantically different positions. They are economically different positions with different leverage, different risk profiles, and different relationships with time. To illustrate this concretely, if you earn $60,000 per year from employment and your investment portfolio generates $60,000 per year in returns, you have reached the crossover. At that moment, you could, In principle, stop working and maintain your lifestyle entirely through capital. Most people who reach this point do not stop working. What changes is not their activity but their optionality. Work becomes a choice, not a necessity. And optionality, the ability to choose rather than be compelled, is one of the most underappreciated forms of wealth in modern life. The portfolio required. To reach the crossover at a $60,000 annual income level, applying the conservative 4% safe withdrawal rate used in retirement planning research, you need a portfolio of approximately $1.5 million. That sounds like a large number, and it is. But let us trace the path from $100,000 to $1.5 million using actual math rather than optimism. Starting at $100,000 with a monthly contribution of $1,500, which represents roughly 2% of a $75,000 annual salary redirected to investments. At a 9% annualized return, you reach $1.5 million in approximately 18 to 19 years. For someone who starts this journey at 30, that crossover arrives before their 50th birthday. Not early retirement in the extreme sense, but financial independence at an age where you still have decades of productive, healthy life ahead of you. The systemic zoom out, there is a broader structural point that deserves your attention here, because it explains why most households, despite generations of working hard, never reach this crossover, and why the gap between those who do and those who do not tends to widen over time rather than narrow. The modern economy is structurally designed to reward capital ownership over labor provision. Every hour you work, you generate value, but you retain only a portion of that value. Capital, on the other hand, compounds continuously, regardless of the hours you put in, regardless of market conditions over long enough time horizons, and regardless of your physical presence. The S&P 500 has delivered an average annual return of approximately 10% over the last 50 years through recessions, inflation spikes, financial crises, and geopolitical shocks. Every single person who consistently invested into that index and did not panic sell through those events emerged with substantially more wealth than when they started. The variable was never market performance. It was always human behavior in the face of uncertainty. And behavior is a function of financial position, which is a function of which milestone you have reached. The trap at this stage. The trap at the crossover stage is sophistication for its own sake. When people approach this level of financial development, they are often drawn to increasingly complex investment vehicles. Leveraged real estate, options trading, private equity, cryptocurrency speculation, each promising to accelerate the timeline. Some of these instruments are legitimate tools in certain contexts, but the historical data shows, repeatedly and across multiple studies, that the more complex the investment strategy, the more variables exist for human error, emotional interference, and fee extraction to erode returns. The data from independent research, including the annual SPIVA reports, shows that over 15-year periods, approximately 88% of actively managed funds fail to outperform the simple index they are measured against. Not because the managers are incompetent, because complexity introduces friction and fees that compound negatively, just as surely as returns compound positively. The most dangerous financial decision a person approaching the crossover can make is abandoning the boring, proven system that got them there in favor of something exciting that promises to get them there faster. Here is the honest summary of everything we have covered today. 3 milestones, 3 different games, 3 different psychological and mathematical realities. The first $10,000 is about removing the scarcity tax on your decision-making and giving yourself the cognitive freedom to think long-term. Every month you operate without that buffer is a month where the math of emergencies works against you. The path there requires automation, frugality not as a lifestyle but as a temporary strategy, and a clearly defined floor that you will not breach once you arrive. The first $100,000 is about crossing into the zone where compounding begins working as a genuine force in your life rather than a theoretical concept. It requires protecting the gap between income and spending, surviving the lifestyle inflation that will try to close that gap, and understanding that every dollar invested at this stage is worth $10 invested in 20 years. The path there requires discipline in the middle, after the initial excitement of the journey has faded, and before the results become dramatically visible. And the income crossover is about transitioning from selling time to deploying capital, from a worker in the economy to an owner in the economy. It does not require genius or luck or inheritance. It requires reaching the $100,000 milestone, staying consistent, avoiding the complexity trap, and allowing time to do the arithmetic that most people refuse to wait for. None of this happens automatically. None of it is guaranteed. Financial independence is not a passive achievement. It is a system you build deliberately, maintain through decisions made consistently over years and decades. But the system is knowable. The math is clear. The milestones exist whether or not you are aiming for them, which means the only real question is whether you reach them intentionally or stumble past them by accident. The people who build real wealth are not unusually talented. They are unusually clear. They understand which game they are playing, which milestone they are targeting, and which traps are waiting for them at each stage. That clarity, more than any stock pick, tax strategy, or side hustle, is what separates the people who make it from the ones who always seem to be one emergency away from starting over. Wealth is not about earning the most money. It is about reaching the point where your money starts working for you instead of against you, and then protecting that position with everything you have got. If you found this useful, subscribe and turn on notifications. New financial education every week. And I want to hear from you. Which of these 3 milestones are you currently working toward? Drop it in the comments below. It helps me understand what to cover next, and it reminds you of where you actually are, which is the most important piece of information you can have right now.